Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are solving April 2023 University question paper under the subject Security and Portfolio Management, also known as SAPM. Again, a very important video for all the TYBBI Sem 6 students. Let us see what all questions have been asked in April 2023 and how to solve them in the most simplest manner. Okay, the very first question that was asked in the paper was the rate of return of stocks SAM and CAM Limited have been given under different scenarios, and they are asking you to find the expected return and standard deviation, and if you could select one of them, which stock would you invest in? Again, simple. We have to first take for SAM Limited. We'll take the probability return and try to find for the expected return and then standard deviation. So the first one will be for SAM Limited. Okay, probability is given 0.33, 0.33 and 0.34 under different economic condition, that is boom condition, normal and recession. The returns are 6, 18 and 15. We multiply them P into R and we get the total. The total is nothing but expected return. Okay, so expected return came to 13.02%. After getting that, the next column will be R minus R bar. So all your return minus R bar. Okay, 6 minus 13.02, 18 minus 13.02 and 15 minus 13.02, we get the returns. We need to square them up. Okay, so we get 49.28, 2.48, 3.92, and then whatever answer you get, multiply that with the probability. Okay, whatever you get, we have to multiply that with the probability. So 16.26, 0.818, 1.33, we add up, we get the total value as 18.40. That's nothing but your variance. Okay, so your standard deviation is nothing but the root of variance. So our final answer comes to 4.29. So 13.02 is the expected return and 4.29 is the standard deviation. Okay, this was for SAM Limited. Similarly, we'll have to do for CAM Limited. Okay, again same logic. First we'll take the probability, that is 0.33, 0.33, 0.34. Returns are 9, 12 and 19. We multiply, we get 13.39 as our expected return. So remember, as per expected return, CAM Limited has more. That was 13.02. This is 13.39. Same way, next will be R minus R bar. Then the square of that, and then the whatever value got, multiply that with the probability, and we'll get the total of variance. Once you get the variance cut total, we take the formula, we apply into the formula of standard deviation, that is root of variance. So the square root of 17.677 comes to 4.204. Now if you look carefully, the previous value 4.29 and this is 4.204, so almost the risk is similar, but as per the return of CAM is little higher as compared to SAM. So if I have to invest in one of them, we would have invested in CAM Limited. Okay, so that would have been your final interpretation answer. So this was the very first question, question number 2C, costing 15 mark, very simple sum. I hope everyone have understood it. Now we jump to the next one. After that, we had question number 3, 15 mark, was based on ratio. They are giving you equity, reserve, preference share, debenture, profit after tax, proposed dividend, market price, current asset, quick asset, and current liability. And they're asking you to find various ratios. Chalo, let us see one by one. First is earning per share. Earning per share ka formula is PAT minus preference dividend upon number of equity shares. So profit after tax is 100. Everything is in lakhs. Okay. Preference dividend is 160 into 12%, which comes to 19.2. Upon number of equity share, 400 divided by 10 is 40. So we minus divide, we get 2.02. Same way for PG Limited. This is the LG Limited and now this is the PG part. Okay. Again, it is profit after tax is 140 minus preference dividend 200 ka 12%, which comes to 24 upon 500 divided by 10, which comes to 50. So we get earning per share as 2.32. Next, they ask you to find PE ratio, that is market price upon EPS. Market price is 400 and 560 respectively, and EPS we have already found. So so this is for LG and this is for PG. So 400 upon 2.02 and 560 upon 2.32, we get 198 and 241. Third is dividend payout ratio. Dividend payout is another dividend per share upon EPS into 100. Now dividend per share, we'll first have to find dividend per share. That is nothing but proposed dividend upon the number of shares. So 70 divided by 40 come to 1.75, and 80 divided by 50 comes to 1.6, divided by earning per share, which you have already found. This is LPG and this way. Okay, we will get the values as 86.63% and 68.96%. Next one, return on equity share formula is preference equity, earning per share, or you can say it is actually profit after share. Okay, it is the profit after tax. So profit after tax minus preference dividend. This is PAT. Okay, minus preference dividend upon equity fund. So it is 100 minus 19.2 divided by 400 into 100. This is for LG Limited, and same way 140 minus 24 upon 500 into 100. So we get 20.0, 20.2 and 23.2. Next one was current ratio, that is current asset upon current liability. So it is 160 upon 110, that is 160 upon 80, which comes to 2, and 180 upon 90, which again comes to 2. This is for LG Limited and this was for PG Limited. And last, no, second last is quick ratio, that is quick asset upon current liability, 110 upon 80 and 130 upon 90. We get the values as 1.37 and 1.44. Debt equity ratio is debt, which was debentures 100 upon equity fund, that is equity share plus reserve and surplus less fictitious if any. So 430 and 550. When you divide, again you get the value as 0.23 and 0.45. Okay, so this is how you all had to solve the sum based on ratio analysis. Okay, various ratios, just have to remember the formula and substitute the value in that formula. This was question number 3. The next one was question number 4a. The details are given of three portfolios. They are giving you the average return, beta, standard deviation. Compare both the portfolio using Sharpe, Trainer and Jensen's measure and rank the portfolio. The risk-free return is 8%. So first we'll go for Sharpe's. Under Sharpe, the formula is return minus risk-free upon standard deviation. Okay, we have B limited, we have K limited, and we have market index. Okay, we applied into the formula. So 18 minus 8 upon 0.3, 12 minus 8 upon 0.35, and 14 minus 8 upon 0.25. We get those values. Now we have to rank them. First is B, second will be market index, and third will be K or K limited. Same way for Trenor's measure, formula is risk return minus history upon beta. Similar, 18 minus 8 upon 1.4, 12 minus 8 upon 0.9, 14 minus 8 upon 1. We divide it and we get the values as 7.14, 4.4.6. Rank में 1, 2 and 3. Okay, this was B limited, this is K limited, and then this is the market index. Okay, this is Sharpe and Trenor. Now we jump to check the third part, that is Jensen. Now Jensen ke liye first you have to find the expected return, that is risk free return plus beta into market return minus RF. So for beta, for B limited, for K limited, and for market index, okay, risk free is 8, betas are given 1.4, 0.9 and 1 for respectively for all. Okay, the market return is given as 14, so 14 for all the cases, and risk free is 80, is again 8. We substitute, we apply into the formula, and we get 16.4, 13.4 and 14. This is not the formula. The final formula to put in into Jensen, the formula is expect the the annualized return minus the expected return. Okay, the average returns were 18, 12 and 14, and expected return we found 16.4, 13.4 and 14. When you subtract it, we get the value that 2.95, 11.4, but negative, sorry, 1.4 negative and 0. Ranking wise, we'll have rank 1, this will be 2, and this will be 3. Okay, this is how you'll have to solve the sum based on Jensen's measure. This was question number 4a. The next question in this paper now was question number 4b, which was based on YTM. They're giving you the government bond is 1100, coupon rate is 9%, maturity period is 7. If the current market price is 1020, find YTM. Formula again, interest is 9. Okay, 9% which is given. They are giving you 9%. Face value is 1100. Market value is 1020. number of years is 7. Okay, the formula of ITM is 1 I plus face value minus market value upon n. The whole thing face value plus market value upon 2 into 100. Okay, once we get this, now we substitute. So 100 and 1100 into 9% is 99 plus 1100 minus 1020 upon 7 into 100. The whole thing upon 1100 plus 1020 divided by 2. Okay, now once you get this substitution, okay, it comes as 99, keep it aside. This will become 80 divided by 7 upon 1060 into 100. So we get 110.42 upon 1060 into 100, and final answer comes to 10.4%. Okay, so this is how you'll have to solve YTM. Now the last question which was there in the paper, okay, calculate beta of Sachi Limited. No, this also was on 8 and 7 and 8. Okay, so 5A may it was asked to find beta. First, we need to note down the year, the return, and the market return. Get the total. Okay, once you get the total, we need R bar, that is 78 upon 5 and 81 upon 5. We get those value. Then now we need to find R minus R bar and RM minus RM bar. Multiply them. Okay, we get the total that comes to 3.4, and then RM minus RM bar the whole square. Okay, and the total of that. Once you get the total of both those columns, the next is covariance, that is, the second last column ka total upon n minus 1, that is 5 minus 1, which is 4, which comes to 0.85. Next we need to find standard deviation square m, that is last column ka total upon 5 minus 1, which comes to 1.7. And lastly, we need to get the value of beta, which is 0.85 upon 1.7, which comes to 0.5. Okay. So 5.8, this is how I like to solve the sum based on beta. One last question in this paper. Calculate operating leverage, financial leverage, and combined leverage from the following. Outputs have been given: sale, variable, fixed, interest, and income tax has been given. First, we need to find income statement. Sales will be selling price into output. So 2 lakh into 3, that is 6 lakhs, and 2.5 into 1 lakh is 2.5 lakhs. Variable is 1 into 2 is 2 lakh, 1.5 into 1 is 1.5 lakh. You minus, we get contribution. Fixed cost is already given as 1.60 and 70. We take it as it is minus, we get EBIT. Interest given is 40 and 20. We take it as it is. We subtract it, and when we get it as, okay, so 2 lakh 40 minus 40,000 is 2 lakhs, and 30 minus 20 is 10,000. Okay, this is, and then we have to find tax. 30% tax, so 2 lakh ka 30% is 60,000, and 10,000 ka 30% is 3,000. So earning after tax will become 1,40,000, and the earning after tax for the other one will become 7,000. Okay, once we have got that, once we got these values, now we can substitute into the formula. First is operating leverage, which is contribution, which is 4 lakh and 1 lakh, upon EBIT, which is 2 lakh 40 and 30,000. So we divide, we get the values 1.16 and 3.33. Next is financial leverage, which is EBIT upon EBT. So that's 2 lakh 40 upon 2 lakhs, so which comes to 1.2, and here it will become 30,000 divided by 10,000, which comes to 3. And last is combined leverage, so it is 1.66 into 1.2, which comes to 1.992, and here it will be 3.33 into 3. Okay, so we multiply that, so it will be 3.33 into 3, which comes to 9.99. Okay, so this will be 9.99. Okay, so this is how you'll have to solve the sum based on leverages. Okay, so these were all the various questions which were there in the question paper of April 2023. Okay, so I hope everyone have understood that. With that, we will be ending this video here. Thank you.